Hi everybody. For anyone who's joined, we're just going to give it 30 seconds to a minute just to let a few more people in. So please bear with us and we'll start promptly. Hi everybody. I'm just going to give it another minute just to wait for a few more people to join and then we'll be kicking off. Okay, great. I think it's probably time to start now. So hello everybody and welcome to part two of our Basel Endgame series. Today we've got Basel Endgame in practice and what US banks should do next. So following the strong interest in our previous session, we're delighted to host this follow-up session today. I'm Kira Snow and I will be moderating. I have over 2 decades of experience in the banking industry, and I specialise in regulatory compliance and large-scale regulatory change. I focus on implementing reg tech solutions that help institutions navigate evolving regulatory expectations. And I have a particular focus on US regulation, but also my experience spans both Europe and the UK. So before I introduce our key speakers and our experts today, just give you a quick brief overview of what we're going to be covering. So in this session, we're going to be moving beyond the headlines and we're going to be focusing on the practical implications of Basel III Endgame proposals, what they mean for banks, and the implementation challenges ahead. And then we're going to give some practical first steps that banks can take now ahead of the final confirmation. So if we could just go back a slide for a second, please. Thank you. So these are some of the key changes we covered in the last in the last session. So I'm not going to be going through these in too much detail today, but it just gives you a brief look of what we did cover. So if that's something you're interested in, please reach out to us and we can send you the webinar or the link to the webinar for that session. Thank you. So if we could go to the agenda slide. So I'm going to start by introducing our speakers today. So I'm very pleased to be joined by Fiona Humphrey. Fiona is a dynamic finance leader with nearly 3 decades of experience, whose career has spanned the globe, including the world's major financial centres. She is renowned for her risk management acumen and proven ability to deliver ambitious regulatory transformation projects. Fiona has consistently driven impactful organisational change and built high-performing teams within several prominent global institutions. Beyond her executive achievements, Fiona is also committed to making a difference, serving on the board of a non-profit that empowers communities in northeastern Ghana, as well as supporting the professional development of colleagues and fostering emerging talent through the industry through mentorship. So thank you, Fiona, for joining us today. I'm also joined by Akhil Khunger. He is a Vice President of Quantitative Analytics at Barclays, with over a decade of experience in financial modelling, stress testing, and risk management. Akhil specialises in end-to-end development of machine learning and statistical models for global institutions, including previous senior roles at Citigroup and HSBC. A frequent industry speaker and thought leader, Akhil is currently spearheading AI-driven automation initiatives and has been recognised as a fellow by the British Computing Society. He holds a Master of Financial Engineering from UC Berkeley and an MSc in Financial Mathematics from the London School of Economics. So hopefully we've got a lot of experience in the room, and we can lead an interesting and engaging discussion. So very quickly, if we look at the agenda, so we're going to be covering what's changed in the last proposals, the key implementation challenges, the strategic implications, and practical first steps. So that's enough of me speaking for now. So I'm going to hand over. I've got a first question for Akhil. So, Akhil, at a high level, what has actually changed compared to the 2023 proposals?
Yeah, thanks, Kira, for the introduction. So I think like there's been very significant changes compared to 23 proposal. I think the first changes in terms of the ERBA that it is mainly applicable for category one and two banks. Category three and four are not required to, but they can choose to. It's optional to opt in. And then I think also an opt-in feature, it will give time up to 5 years for the companies to opt in properly from whenever the date comes in, and the date is not yet final yet of the implementation. Another thing is like to give some examples like which are being good for the banks, like the inter-affiliate transactions were initially said to be at 40% risk weight, and they've gone back to be they're going to stay at 20%. Corporate proposal reduced from 100 to 95%. So some of these examples show that this could, like in terms of more capital available for the banks. In terms of market risk, we see that the the companies under scope have been increased from 1 billion in assets to 5 billion in assets. So that means that only who are actually dealing more with like not just hedging certain positions are actually being active in the market will be subject to those. And there is where you have still option of using advanced like model based approaches and not just standardized approach. And there I think the key point is that if you're using model based approaches, you will have to move from value at risk to expected shortfall. And I think last but not the least, I think CVA requirement is also like changed like to like there's like has to have 1 trillion in notional exposure, derivative exposure to to be part of like CVA requirement. So yeah,
I
I think
think these
these
are
are
some
some
of
of the
the
key
key
changes.
changes.
Thanks, Akhil. I think we've got a little bit of feedback there.
Uh, not sure why it's that.
Okay, is that I think hopefully that's better now.
Yeah,
Not sure what's
is
is
it
it
better
better?
now?
No, I'm afraid we're still getting a little bit of feedback.
Uh,
Uh,
it's
Oh, I think that's better.
yeah. Mm,
Great.
Eight. Okay. Is it like I like just try to move? Is it better now?
That's better.
Yeah. Yeah.
Fantastic.
Okay.
Thank
Sorry
you.
about that.
No worries.
Yeah. 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 So yeah, I think those were like some of the key changes. Yeah, I wanted to talk about, and yeah.
Great. Thank you. Um, so I'd like to kind of move on to, and Fiona, I'm hoping you can kind of field this question. So one of the things that I'm really interested in is how that's actually impacting the strategy in banks. So how do you see these evolving capital requirements reshaping business strategy? And is it reshaping business strategy?
I think one of the things that people need to be careful of is not to be reactionary when regulations come in. And especially if you think with Basel, it's been around over 20 years, and gone through series of evolutions. We've seen, some knee-jerk reactions kind of after the global financial crisis in '08. Really quite, big changes at that time. A lot of like lasting large programs and things like that. Now we're kind of you see a little bit of rolling back, even when a new proposal and that comes out, and we're still not final with the calibration of this. So being reactionary is never a good strategy. You should never be building your strategy around regulation, but obviously you need to incorporate it, and it may help make some decisions. There's been a time in banking where everybody's been doing every product. And then you've been seeing a bit of a pullback where people have been saying, well, the burden of trying to, manage all of these products and meet all of the regulatory expectations for those is just too much. And so this might again be another opportunity where people take a look and say, is this a business I still want to stay in? Are these changes going to have any impact? Or, maybe I can stay in this area, but so it's more those kind of things as opposed to fully reacting to the changes. A lot of what people are doing is, there's a lot of banks at the moment in the US that are all at very, very different stages. You've got the GSIBs and everything that they've been involved in a lot of the big regulation and the CCAR and all of those kind of things for more than 10 years now, pretty more like 15. Then you had a whole bunch of the kind of foreign banks that about 10 years ago really had to build intermediate holding companies, and Basel III kind of came in at that stage, and there was a lot of change for them. But now we're seeing kind of another wave of kind of banks coming through. We're seeing a lot of M&A activity, especially regional banks. And if you think of the way regulations come through, there's a lot of what's going on politically in the background, what's going on economically. We saw the regional banking crisis in 2023. And I think that gave the regulators, oh wait, let's really push Basel Endgame at this point, even though that crisis had nothing to do with capital. So again, it's just not to be reactionary, be thinking about what's happening. A lot of these mergers coming through with the regional banks, and they're going to be making some decisions. Some of them are going to say, if you're around those kind of categories, the tailoring rule has really helped. I think help people form strategy and decide what you want to do. And there's a number of banks who are saying, well, I'm close to that tipping point into the next category. I'm going to make sure I stay under. Then you've got others who are saying, I'm going to make the absolute decision to leapfrog over. And in doing so, they're going to form acquisitions, their mergers, those kinds of things. So I think there's more deliberate actions as opposed to, oh, this is going to tweak this from strategic perspective rather than tweak this number or this ratio.
Great, thanks, Fiona. That's really interesting. So, Akhil, sort of turning to your area of expertise, do you see changes in risk measurement reshaping the bank's business strategy?
Yeah, I think like just to give an example, right? Like from 2023 onwards, from when the original proposal came to, like there have already been discussions on how to look at, like, because we know this is coming, it's just that we don't know how the exact format it will come in. So another thing is that I wanted to touch point before going into some example that some of the foreign banks like Barclays, they are governed by UK regulations, or where there's also a difference between how the Basel implemented here in US compared to done in the UK or in other European countries, right? So Basel is more stricter, so sometimes you have to follow what has been done in the like what are the requirements in the group area, like for the UK, and you have to make sure that you don't change your strategy or update your strategy too much, because ultimately you're also governed by PRA regulations. uh so that way, like, but we have been making changes like in RWA, in like moving to soccer, and then also uh, like because of the ratings of the collaterals, like we are making it more thorough, like also moving from investment grade, non-investment grade, to moving into speculative, sub-speculative, so that we don't penalize too much for sub-speculative. Like we can't have everything non-investment grade as sub-speculative. Try to have those buckets. So that's way, like the business then has to make a call while doing a business that, okay, we can't have collaterals or like issuers which are sub-speculative, and try to see where to be draw a line and make changes in the way they're conducting the like transactions, like, or trades.
Yeah, absolutely. And actually we're seeing that in the UK. Banks are really thinking about how does my product fit into this new structure? And sometimes it doesn't quite, and those conversations are happening early, with as early as possible with regulators to say, actually, if I applied the rules, as they are today, it doesn't necessarily work for this particular product. And I think that is something that can be brought up in this consultation period. And I think that is key in the implementation to make sure that the rules actually adequately give you a sensible risk output. So yeah, I totally agree, Akhil. Thank you. So, Akhil, keeping with kind of the discussion we were just having, um, what are the main practical implementation challenges that you see banks facing?
Yeah, that's a good point. I think one is that understanding the right amount of resourcing, uh, because like people have been working on certain systems and certain processes for long, and those have been also been more optimized, and there have been like reduction in resources like over time, also strategic changes, and whenever there's a new regulation coming in, a lot of things have to be implemented from scratch. So we have to be careful that people who are in the role or have to be hired like have good knowledge about the policy changes, and about like any like modeling requirement or like data requirement. So that is one thing. And then yeah, I think coming from the last point, that data requirement is another big thing. Like a lot of things require like a very stringent data lineage and data quality. There has been a lot of improvement over that over time, especially because of CCAR requirements, that a lot of this data is available. But then I think a lot of times, like whenever there is certain new requirements, or also when if we think about again going back, if we think about more like from a group perspective, then in Europe the CCAR requirement were not there, so the data may not be that much available or in a better shape for planning purposes. Also because I think Basel is also putting more emphasis on the planning models to be also in scope, so that requires more data. Yeah.
Absolutely. Thanks, Akhil. So, Fiona, I'm going to ask you a very similar question. So, you've got a lot of experience in managing regulatory change and leading regulatory change. So, what do you see as the biggest challenges firms need to overcome in implementation?
Well, I'm going to first touch on a little bit of what Akhil just said around the resourcing thing. And I do think, on a positive side, one advantage we do have is in implementing these regs is so many of these types of things have been done before. You know, we're talking about the years of implementation of Basel, and a lot of CCAR and things like that have been implemented. And so, unlike probably about 10, 15 years ago, where a lot of the banks really had to rely on enormous numbers of people from consulting firms, literally hundreds of people were coming into the firms to deliver. Now, I think we've got a lot of experts in the industry itself, in the firms themselves, many who, when there has been, cutbacks and things like that, are moving from established firms into some of the ones that are just starting some of the journeys. Um, Again, I think everybody's at very different places. So I think that is one advantage, is you've got a lot of people with a lot of experience, a lot of knowledge, in being able to help move that forward. The challenges you have with a number of these firms is pretty much what we're seeing again with the other firms 10, 15 years ago, technology. You've got some extremes at the moment. You've got working with AI and in some elements, and then you've got very, very basic manual spreadsheets still, and very antiquated systems that don't connect, don't talk to each other. And as Akhil was just saying, the flow of data is so important. The quality of the data is crucial. And even going back to what he said in an earlier response around things like collateral and that, it's that communication with the business of when they're doing the transactions, understanding the impact of some of the decisions that they make in those transactions and how that can impact and flow downstream and things like that to some of the risk and finance functions. Um, so the challenge is really seeing holistically across a firm, how do you ensure that everybody's needs are being catered for? And that's one of the things in my current role in new business is helping people realize there are new reporting requirements coming. There are new modeling things, as Akio was just saying before, that need to be done, changes and things like that. But you're having to do all of these changes while you're managing day-to-day work. It's not like you can take time out from doing that. So it's always like fixing, I don't know, a car while it's in motion or something like that. Always brings in challenges. So I would say some of those are some of the big things. Just the competing priorities, as always, balancing those.
Yeah, I think actually that's a really good analogy, and for probably a lot of people on the call and a lot of people who will listen to this afterwards, they're running a team already, and there's a lot of pressure, and then pile on a big regulatory change that can be very difficult. And I think probably a lot of us have experienced that ourselves. So yes, I think that's a really good point. And I also, Fiona, really liked what you said about the overall holistic impact,
Mhm.
because that's where I've personally seen a lot of implementation challenges, that it's almost seen as a regulatory reporting change, and that's certainly not the case. It is a company-wide initiative, especially things like implementing Basel, and it goes straight right from origination, and those customer service people originating the contracts need to make sure that that data collected is accurate, and educating the company that that decision actually has this impact when it goes completely through the machine. So I think that is a really, really good point. And what I've seen from from implementing Basel III in Europe and the UK, is that a lot of people have been bought into this regulatory change that weren't previously as involved. So it's been so far reaching. So I think that's a really interesting point. Thank you. Okay, great. So I think we're going to move on now to talking about practical first steps and what banks can do now to maybe mitigate some of those challenges we've just discussed. So, Akil, I'm going to come to you first. So, given where we are in the process and the uncertainty around the final calibration, what are the practical first steps banks should be taking now to prepare?
Yeah, I think like a lot of banks are already like a lot of working groups have been set up, and I'm sure in every bank, to understand and run a lot of scenario analysis, like how will the capital requirements change, or if this happened, and also look at different economic scenarios, like similar to what is done in CCAR, like how would these requirements change, CET ratios and other ratios like leverage ratio, and where it can be helpful, where it is bad, and try to also strategize. And it is where like try to even build, I think we touched upon, Fiona touched upon, build your strategies around it, like not changing holistically, but trying to maybe grow if you are not sure about which businesses you want to grow, but and you have like deciding between some, like as an organization you could actually maybe go in more with certain one depending on how your results look like, and then probably like educating like the teams like of this change, and going into, I think, the sessions like these, understanding how the other industry people are doing it. And I think there are a lot of VPI calls which happen, which also give information like what are the pain points. And another good point is that I think there's still time to push back on certain changes if you think they can. And I do think regulators would be open to making some changes. So that's a good time to, before June 18, like to go back and ask for certain changes if needed.
Yeah, absolutely. Thanks, Akil. I think that's a really interesting point about kind of economic scenarios and how things can change depending on what's happening in the economy, etc. And that feedback to the regulator is so important, because the regulations were made at a point in time, and things evolve. So if there is something that doesn't make sense now, that's good to feedback. And the regulator is really encouraging that communication, I feel. So that's great. So Fiona, I'm going to ask you a very similar question. So what are the practical steps that you think that banks can take to try to mitigate some of these regulatory change challenges?
I mean, the always starting point for a lot of these things is you run a gap analysis. Um, And I think we're all familiar with those. The good thing is the way technology is moving these days, we can start to use things like AI, and that help to give us a lot more insight. But I think the thing you need to be careful of is when you're doing that is really understand the implications on your business, not just the line by line, where you're at against the rule, but as you were saying before, thinking economically, thinking too of your business, because different ratios, different regulatory requirements, different thresholds and things like that have more impact on different banks depending on what type of bank you are and what your strategy, what your product suite and everything is. Because some of the time you'll find that some of the regulations and some of the numbers and things that you're calculating and the thresholds you're managing to, they actually contradict each other. And so you go too much one way, you're actually impacting the other one in a negative way. You can't go all in positive one way, you can't go all in positive another. I was saying to someone the other day, it's a bit like whack-a-mole sometimes, where to try and, keep that balance. So really having an understanding of your business, really doing that gap analysis, and then layering in what does that really mean for your business, so that you're not playing the game of whack-a-mole, or you're not focusing, you're prioritizing more appropriately. And then education, so that your board, your senior management, all of that, they know what's coming. And so does the rest of the firm. If there are going to be new data requirements, if there are going to be changes in some of those things you need, I think the earlier that you can get in front of people and get them to buy into the why. Like you were saying before, it's very easy for people to be like, well, that's just a regulatory requirement. Well, it is, but it's going to impact RWA, which means you've got less capital that you can then use to invest in your business, and you're going to be charged for it. So how can we have the conversation now that, you don't suddenly get these charges that you're like feeling penalized or feeling hard done by? Um, Again, it's like it's communication. Um, and then again, everyone's at different places. So if you've got people who or firms at the moment that are focused on they're going to be incorporating new intermediate holding company, or they're going to be filing CCAR for the first time, in a couple of years, they've already got big regulatory things going on. All right, well, how do you just incorporate that as well? You don't want to stand up another big program. You want to try and bring that in as much as you can. So I think those are some of the key things.
Great, thanks, Fiona. That's really, and I think that's really important. That early buy-in at all stages means that once the program starts, it just runs that bit more smoothly. Um, and I think that what I've seen, particularly in the UK markets, is no one's going to regret spending or spending time on making data better, making data more granular, because regulation is moving that way. So even if calibrations are changed in the final rules, that's kind of a no regret action, making that data work that also feeds the whole organization. So where I've seen banks be the most successful are those that have invested early in those no regret actions and invest in their data. So yeah, I think that's a really good point. Thank you. So I just wanted to say thank you both so much for all of your insights today. So we do have a poll for the community online. Um, so we're going to pull that up now. So before we sort of sign off, we thought we would see your thoughts on the subject. So what do you see as the biggest implementation challenge? So it's a single choice. So if you could vote now, that'd be great. And then we could just take a minute and we could have a look at the responses. It'd be interesting to see what the wider community feel here. Great. We'll just give it another 20 seconds or so before we show the output. Okay, great. I think that's going to come up now on screen. Thank you. Um, Fantastic. So this is an interesting and not too surprising, the output of this poll. So 69% believe that data quality and lineage is the biggest challenge. We've got model redevelopment and replacement. That's definitely something that banks are facing, and cross-functional governance and alignment. So that's really interesting. And it's actually interesting that operating parallel capital frameworks isn't one. So that's great. And I think that the cross-functional governance and alignment is something that I've definitely seen across other banks too, who have implemented Basel III across the globe. It's getting alignment from risk, from your engineering team, from your potentially your providers, and there's a lot of ducks to put in a row. So that's definitely a key one there. Okay, well, thank you so much for your engagement, everyone. So before I end the session, I'm just going to turn to Fiona and Akhil for any last words or any words of advice. Akhil, do you want to go first?
Sure, sure. I think I just want to add, I think like we touched base a lot on the other point, but I think given there's a lot of US-based GSIB banks, there's a lot of changes in GSIB also, just to keep in mind GSIB methodology, which is going to help reduce the requirements a lot, like reducing the surcharges to 10 basis points from 50, and overall like changing certain other factors. And then another point I would like to add is that there's certain other regulations coming in. Like last week, there was a regulation on like SR 26.2 replacing SR 11.7 for model validation. So those things will have, and because all models go through the model validation. So, and given changes in that, and and then like joining with these things, like all strategy and any changes in the implementation will have to be looked at holistically, not just looking at these regulations as a whole. And then also, like as I said, like it's not just US regulations for global banks. They'll have to look at other regulations like PRA and some EBA and so on, right? Yeah.
Absolutely. No, that's a really good point. Thank you, Akhil. And I think that making sure that you take a more holistic approach stops the whack-a-mole that Fiona was talking about earlier. So yeah, that's a really good point. Thank you. Fiona, have you got any last words of advice or final thoughts?
I mean, I do think you're exactly what Akhil was just saying before, and what we've talked about throughout this thing around that holistic, that forward focus. It feels, and maybe this is just me, but a few years ago, probably about 10 years ago, the regulatory pressure felt so much more intense. And maybe that was because I was really in the middle of it. But it really did feel so much. I feel like there's been a little bit of pulling back, which I think is always a good thing. You put something in practice, like with anything, you write a policy, you put a new procedure, you see how it goes, you tweak it, and then, depending how things go, you can change that. And I feel that's what a lot of this is really having seen things play out. Um, and so really that focus of, yes, if you are an international firm, like the foreign banks, you've got many regulators you're trying to satisfy. Um, you do want to be trying to see, well, how do I do it smartly? How do I do it once? Look at the foundational elements of your firm. What is always, regardless of regulation, going to be necessary? And how are these things going to evolve? I think the data thing is incredibly interesting because it just seems so incredibly difficult. And I feel like we're always going, why is this so hard? One of the interesting things coming through, I think, from the AI perspective is there's certain elements where you absolutely need to focus in on your data quality. But then you've also got a lot of new tools coming through AI where you don't need your data to be as structured. And so I think there's some elements there where we're going to see some, okay, maybe lineage and things is not going to be quite as important. I know, for the regulators that has been, but maybe with AI and being able to do some things, that's going to change. But data quality is always going to be there. So I think sticking to your foundational elements, I think is always going to be the way to go.
Brilliant. Thank you, Fiona. That's really helpful. And I think that I totally agree. Regulation I've seen over the last few years um, is trying to keep the robustness but be simpler. So, and actually, regulators across the globe are heading in that direction. So, making sure that consumers are still protected, that they're still fulfilling their priorities, but we are definitely seeing a shift towards simpler, more data-driven regulation. So that is a theme across all banks, regardless of jurisdiction or whether you're cross-jurisdictional. So I totally agree. Getting down to that foundation level is so important. Okay, well, thank you both so much for joining me today. It's been a really enjoyable session and really interesting. Thank you for everybody online who joined us today. I hope you found that useful. So if you want to know more, please keep an eye on us on LinkedIn. We run lots of informational sessions regularly, so please join us in the future or check out our website too. So thank you to everyone and have a great day.
Thank you.
Thank you.
Thank you.